Wake me up when September ends. That classic song by Green Day could not be more true this year in 2023. August was awful. September was shite.
So here's a recap. Poop, nasty, doo-doo, stinky, caca.
But despite all the pressure on stocks, we want to be buying something right now because all that pressure is what makes diamonds, baby. And there are a lot of stocks out there that right now, after this big pullback we've had in the market, are looking very, very attractive.
Keep it in your pants, Anderson.
So 5 stocks I'm buying coming up right now. Chris from Stock Dads here, exclusive analyst in the Stock Dads Discord, and we talk about trading and investing on this channel. And in today's video, we're going to be talking about everything that's going on with the market and some stocks that I've identified that could be amazing long-term investments. So in the past 2 months, the S&P 500 was down as much as 8% and the NASDAQ was down almost 10%. A lot of these tech stocks are great for the long term. I'm talking about a minimum of 1 year into the future, if not several years into the future. So we're gonna take advantage of this discount and I'm gonna show you all the due diligence and the reasons why I'm investing in all 5 of these stocks, starting with stock number 1.
You have every reason to be excited.
So stock number 1 is JFIN Stock, JFIN Group. This is a Chinese fintech company in the online consumer finance space, and specifically their platform helps to connect borrowers to lenders. JFIN is a $300 million company trading at a PE ratio of around 1.6. This makes it incredibly dirt cheap compared to other fintech companies and even the overall market, which trades at a PE ratio of around 18, 19, or 20 right now. And because they're making so much money right now, they've recently instated a new dividend policy. And that dividend policy is designed to give back at least 15% of earnings to shareholders in the form of dividends. And they just did their first payout earlier this year, a few months ago, for 40 cents per share. If you annualize that, because they do pay that dividend twice per year, that could mean 80 cents in dividends, which would be almost a 15-16% dividend yield right now. And you can't find that anywhere else in the market really for a company that's actually growing profitably.
This is a friend of ours from China.
Even though China has been struggling economically, this company is actually gaining market share and doing well in this difficult macroeconomic environment. The company raised their guidance in the latest quarter for loan origination volume. So that's a really good indication of future earnings and revenue as well. So I don't see this company slowing down at all. The share price of this company has already risen a lot over this year, about 100% since January. I think it could continue. So in JFIN Stock, you have a company that is growing profitably, is paying back dividends. There's not a lot else that you can ask for. So JFIN Stock is a great option in my opinion.
Thank you very much, Facebook.
I just don't know about all the meta stuff, you know?
Moving on to stock number 2 is Meta stock. This is a stock that I've loved for a long time. It's been up, it's been down. The company formerly known as Facebook has a lot of detractors. A lot of people hate it. But even after all the controversies, pretty much since Facebook's beginnings, there are still billions of people using it, and the number of users have actually started to go back up, which is a very positive sign for Facebook/Meta. I think that the core business is showing very positive signs here. In their latest earnings report, they beat estimates and they also raised guidance for the rest of the year. So a lot of people are starting to get more optimistic about Meta stock. They've gone through a lot of trouble because Apple pretty much made it impossible for apps to track people. Nevertheless, they've gone through that and they've also started to monetize the other platforms as well. You can see like Instagram Reels, they're starting to make more money on that. They're also starting to monetize WhatsApp in different ways. Revenue and net income are starting to trend back up, and as I mentioned, growth in users are starting to tick back up after a few quarters of decline. These are all very good signs. And you can see Meta right now, if you look at the forward PE ratio, is one of the best, if not the best, amongst the big tech stocks right now in the stock market. I'm seeing the forward PE ratio here is around 18, which is very affordable, and it's actually below the average over the past 5 years for Meta stock, which is sitting somewhere around a forward PE ratio of 22. So you're getting in Meta here at a good discount, as well as right now you can see some trends going for Meta for its advertising business and the potential upside for artificial intelligence with their large language models, more with the metaverse. All these ancillary sides of their business help with the stickiness of their overall ecosystem. As long as that ecosystem stays healthy, Meta is a perfect stock to buy. And by the way, you can see that Meta over the past couple of months here has actually been one of the most resilient big tech stocks as well. You see Apple been under the cosh. Microsoft has kind of been going nowhere for a longer time now. Nvidia, for example, is another one that was a huge runner and has pulled back. Meta is actually barely down from its high that was set 2 months ago. So I think that relative strength just goes to show you that a lot of investors are interested, and once the market picks back up again, Meta could be one of those leaders.
I'll drink to that. My tech stocks tripled in 5 days.
Stock number 3 is Amazon stock, and everyone knows this massive e-commerce company that's doing almost $1 trillion in revenue every single year right now. Their latest quarter, they did over $130 billion in revenue. But you have to make sure that you don't see Amazon just as an e-commerce company, because really a lot of what they're doing right now is advertising and cloud. And Amazon, I think, is underlooked right now for its AI potential, right? Everyone is saying that artificial intelligence is going to be the next big shift in technology. It's going to be as big as the internet, mobile, or even bigger than that right now. And Amazon is going to power all of that with Amazon Web Services, because all of those, huge language learning models, all of those apps and softwares, all of that's, running through AWS. Amazon's Web Services has been a huge driver for its profit. In fact, it's the majority of Amazon's profit. E-commerce is not really as profitable as you would think for Amazon. And that has been slowing down over the past couple of years, but I think it's about to pick up massively, because every single company is going to adopt artificial intelligence in some form or another. Amazon is developing and offering its own model, and it's also offering other people's models. One-stop shop for everyone that's trying to build these AI tools. To take a step back and put things into context a bit, back in 2020, everyone was using Amazon, right? You're buying toilet paper on your phone. Everyone was moving their businesses online as well. So AWS, more and more important. Digital advertising, more and more important. So Amazon was absolutely flying. I mean, the stock also was phenomenal, killer. But over the next year or two after 2020, Amazon stock has been absolutely flat. It's absolutely done nothing. In fact, it's gone down from where it was. But right now, we're about on the cusp of that AI wave, and it's a good time to buy here when the price has been pretty deflated for a couple of years now. In the past quarter, they beat estimates. Revenue was up 10%. Net income was billions and billions of dollars. Their guidance for the coming quarters also look promising. And looking further into the future, we see that Amazon is serious about artificial intelligence, investing up to $4 billion into a startup just this past week. So big things could be on the horizon for Amazon stock, and thus I am a buyer right now.
You sound pretty convincing so far. What do I say after that?
And if you're liking all these stock picks so far and you're not subscribed already, I don't know what you're doing. Make sure to hit that subscribe button right now. Let's go into stock number 4.
Number 4, step forward.
This is a regular on the Stock Dad's channel. Stock number 4 is PERI on Network, PERI stock. PERI stock is a $1.5 billion ad technology company, and I think this is still one of the most undervalued companies out there in the entire stock market when you consider the growth that it has, as well as the valuation. PERIon has a very diversified digital advertising business between search advertising, where they are a huge partner with Microsoft Bing, as well as display advertising, streaming platforms, social media, connected TV. They've done campaigns for very big clients like Mercedes-Benz, Beyond Meat, Walmart, to name just a few. And they're getting more and more clients signed up right now, especially when it comes to their sort technology. This is a cookieless solution that they've developed that uses artificial intelligence to make sure that their targeting is as effective as possible. And according to studies, sort technology actually performs several times better, producing better outcomes for its customers. Looking at financials, PERIon has consistently done over 30% revenue growth for a couple of years now, and EBITDA growth in some years of 50 to 100+%. This year is a bit of a slowdown. They're reporting about 15 to 20% revenue growth this year. They did raise their forecast for the rest of this year, but it's a slower year, yes. There are a lot of macroeconomic problems going on right now with advertising budgets being cut. A lot of people are concerned about a potential recession, so I totally understand that. If we go into the future for the next 2, 3, 5 years, advertising is going to improve. And I think this company is poised to take advantage of a better economic environment and produce even better growth. Considering the valuation right now, it's still extremely undervalued, as I said. The PE ratio right now is only 13, which is way below the market average. Meta stock trades at a forward PE ratio of around 18. PERI stock's forward PE ratio is like 10. So that's just nuts. They have no debt and $430 million in net cash. That's a lot of cash. I think that you're just getting an overall great company with good business prospects at a more than fair valuation here. At one point, it hit around $42 per share earlier this year, and I do think that at that point, it's more of a fair market valuation. But right now, it's too cheap. So PERI stock, still a great stock to buy.
Well, kind of saving the best for last.
And finally, you've been waiting for this, I know. Stock number 5 is going to be OPRA stock, OPRA. OPRA is a Norwegian software company focused on browser technology and right now incorporating artificial intelligence into those browsers. They started off with just the Opera browser, and then they got into the mobile version, and then they created a new version exclusively for gaming, and that's getting a lot of traction as well. Overall, they have over 300 million monthly active users, and the way they've been monetizing actually is very impressive. Average revenue per user has increased 30% year over year. So they're making more money. Even if they have a little bit of a churn rate, they're still making more money off of each user, and that is more than making up for the difference. The past 4 quarters have really been a game changer for Opera. They started to be profitable as a company. Their latest quarter, they did 13 million in net income. What I like about this is that not only is this a great growth stock, we're also talking about a massive dividend. For 10 consecutive quarters, this company has produced over 20% revenue growth. Over the long run, this company can continue to deliver double-digit revenue growth consistently. So that does help justify the valuation, which is currently at a PE ratio of around 20. I would like to see that PE ratio be a bit lower, maybe about 18. For now, it's still a starter position, and I like it a lot. The company does have a strong balance sheet of almost no debt and over $90 million in cash that they can use to deploy and invest into more growth. This company is not without a headwind here. They are registered to do up to a $300 million share offering. I will say that that's not money that's just going to disappear and they're just going to dilute shareholders, right? I do believe that they're going to invest it smart, and that could potentially fuel further double-digit growth for years to come.
A little bit of opera goes a long way. Right, Bruce?
So there you guys have it. Those are 5 stocks that I'm buying right now at the end of September going into October. And I do think that these are going to perform very well over the long term, talking about years from now. If you like this video, make sure to give it a big like and check out our other ones. You might see some other stocks to watch. I'll see you in the next one. Good luck trading and investing in the stock market.
Stocks, bonds, objects of art, real estate. What are they?
It's a fine opportunity for some lucky someone.